Well, Manish Gunwani is our market master today. He's Chief Investment Officer at Bandhan AMC. Manish, good morning. Good to have you with us here. Thanks for your time. I mean, I think, mutual funds are all smiles, right? Big inflow.
Yeah, nothing to complain about.
43,000 crores and an SIP book growing. This is the best of times we've had. Manish, just give us a sense of what you're doing with the flow, though. That's the other part, right? Because all of that money is going in. You can't sit on cash.
Yeah.
And you got to put it to work. So are you expanding the universe beyond what you would traditionally look at, to look at maybe smaller companies and ones where there is some not just the large caps or the top 100, 150, 200 names in that sense. Are you forced to do that, Manish?
We're not being forced. Actually, we've always been of the view that structurally the small cap space is the most interesting space in the market. Now, of course, after such a strong 1 year, if you have a short-term time frame, you should be a bit wary of small caps. But if you have 3-5 year kind of view, essentially our view has been that between the themes of high liquidity, the kind of change we are seeing globally and in India, and the fact that overall macro growth, I don't think will be great globally. If you combine these three big themes, I think we will reach a conclusion that large caps may struggle to report any strong earnings growth, whereas a lot of selective small caps, which play on themes like energy transition, China plus one, consumer discretionary affluent, and luxury consumption. A lot of the small caps in these spaces, I think, can compound earnings very fast. And given the high liquidity, I think that's the space which will generate alpha.
Okay. Manish, hi, good morning and thanks for joining in. Absolutely right, no complaints for this market. But what do you see as the trajectory over the next 1 to 2 years? I'm asking because this market cannot go up endlessly. At some point, a correction has to come. Do you think, if not a price correction, there could at least be a time correction which would allow this market to fall into that range of 12 to 13% gains that we've seen on an average for so many years, right? So correction to a mean, so to speak. What is the best way for a retail investor to look at it?
No, you're correct. Logically, that's what should happen. It's taking some time, but I think that even if everything else remains superb in terms of macro fundamentals, corporate earnings, we have to remember that equities can't generate excess return over fixed income beyond a point, because at some point, capital will then start flowing to equity so much that the promoters and the private equity funds and global companies will come and supply. So we're seeing, for example, a big auto OEM globally is coming and listing in India because valuations are high. So just because liquidity is high doesn't mean that market will give you opportunities to make money so easily all the time. So yes, I would think that you should be realistic about returns. Next 3, 6, 9 months, market can be flat, may have a minor negative drawdown as well. But I do think that, again, if you talk about 2, 3, 5 years, given the liquidity, that it is a stock pickers thing in small caps, that if you can find companies that play on big trends and have management that can execute, I still think that good stock picking will get rewarded.
Hi Manish, good morning and good to see you. And since you briefly mentioned autos, I recall you being positive on PVs as well as two-wheelers, if I remember correctly, not so much on CVs. The top gainer on the Nifty currently is Maruti and the top loser is Mahindra and Mahindra. What's your preference from the basket as of now?
No, so in general, I think two-wheeler stocks have done well, and we should remember that this is a fairly penetrated category. So as a fund manager, I don't see too much upside in two-wheelers. Bit of change of view on CVs. I think I'm more positive now than, let's say, 3-6 months back, because see, usually what happens, CVs have a very severe down cycle and then they recover. But I think in this current cycle, they've got a consolidation phase which has lasted. And end of the day, you're looking at the market relatively. So I'm not saying that CVs are a great distressed valuation, but relative to a lot of other capital goods and cyclical companies, today CVs don't look that bad. I think four-wheelers is a bit of a stock pickers thing. I mean, there are a lot of policy changes happening. Maybe auto anchors are a better way to play because the pace of EV adoption is not very clear at this point of time. And in a lot of OEMs, you then have to choose based on who's got the better EV portfolio, etc. And given the uncertainty around how fast EVs will get adopted, OEMs are a bit of a tough choice at this point of time. Auto anchors have also done well, so nothing is cheap, to be honest. But if you want to do buy and hold patient investing, I think auto anchors in general are better than OEMs.
So, for M&M, right? I mean, of course, the stock has had a very strong run in the last 1 year. Let's not forget that. But remember, yesterday, M&M cut prices of one of their popular SUVs, the XUV 700. Prices were cut by 10% from 21.5 lakhs to 19.5 lakhs. So, a lot of analysts say that this signals demand weakness. I mean, so perhaps that could be one of the reasons. But in any case, the stock has also seen a big appreciation if you look at the last, not the last couple of months, but if you look at the last 1 year, it's been a phenomenal run there. So, Manish, for just a follow-up before we move on to the next sector, for companies like M&M, where maybe there is valuation discomfort now, and perhaps there's some demand weakness as well. Do you think that the time has come to churn out maybe into other pockets like commercial vehicles? Just trying to understand how to move in this space.
So I can't answer for a single stock, but
Sure.
as I said, in general, my view is large caps across, whether it be autos, capital goods, financials. Given that globally GDP is going to grow slower and slower, India will obviously be a relative outperformer, but if global GDP is not going to grow gangbusters, you can't expect very strong cycles to happen in India. So you have to play these small cycles that happen. In that sense, as I said, at this point, auto OEMs, which have done very well for last 12 to 18 months, I don't think there's any big value there, honestly, unless as I said, you're able to pick a policy direction on, let's say, EVs and choose a OEM that rides on that policy direction. It's a bit of a risky call. But apart from that, I don't think there are any secular growth at a reasonable price kind of ideas in autos at this point of time. So I think the more powerful theme is energy transition, which is a global theme. The addressable market is higher, but there also stocks are not very cheap. But these are themes you have to keep churning. I don't think this is a buy and hold market. Clearly, valuations across the board are not cheap. Clearly, as I said, you're not going to get very, very strong growth in credit growth or auto sales. So you need to churn your portfolio wherever there is a bit of pessimism. So as I said, I just see some relative pessimism on the CV cycle. And a small bet there may make more sense today than the passenger side.
Okay. Well, a point taken. Some of these holding companies, Chola Holdings, for example, is up about 6%. And we've, Bombay Burma and some of these other holding companies have been doing very well. Chola Holdings will come up. It's got large volumes on it. That's the mover today. CESC, the tariff adjustment higher happened yesterday. It's up another 3% this morning. So there are follow-throughs in Maruti and CESC, the two big single stock movers from yesterday's session. There is Manappuram, which is in the mix now. It's up 3.5%. 214 on Manappuram, was not there when we started the session. And of course, the railway, RVNL, IRFC is another addition. IRFC is up 3, is the second largest volume traded name. And of course, CAMS remains higher by about 6% or so at this stage. These water companies, water purification companies, Ion Exchange, 4%, Viatec Vabag is up about 2%. So some more stuff which is showing through. Jewelers is another pack. Yesterday, Senco was down 5%. Senco, of course, at the business update, we had the management with us. But others like Kalyan and even a smaller old name, TBZ, Tribhuvan Das Zaveri, these were large movers yesterday. I can spot Kalyan, which is up about 3.5%. So there is, a fair bit of activity which is coming up. Manish, for those who are doing it themselves, and of course, there is enough money being handed over to mutual fund managers, but as you say, this is not a buy and hold market, it's a buy and sell and then buy again kind of a market. So you jump from pocket to pocket, trying to find that relative underperformance or relative valuation comfort. So apart from what you mentioned, any other pockets where you find that?
So the 3-4 themes which we like are real estate, pharma, the energy transition, capex. IT, I think, is not too bad, although I'm not very positive, but being underweight IT any longer doesn't seem to make sense. These are the pockets where we see relative valuation.
Okay. All right. We'll leave it at that. Thank you so much for joining us. Appreciate your time here.